You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Adam Hamilton, CEO of ZealLLC.com. Welcome to the show, Adam.
Thanks so much for having me, Jim. It's great to be here.
Looks like with the equity markets, the German DAX might have been the first to blink.
Yeah, it's fascinating. A lot of traders believe the German DAX is a leading indicator. It's the biggest, most important market in Europe. And it topped back in early April, and it just slid under 10% correction territory last week. And so it went deeper today after those debt talks in Greece failed. And so it's really interesting. If the DAX is rolling over into correction territory, are the other markets far behind, specifically the U.S. markets? And a lot of people think that it is going to prove a leading indicator. Pretty interesting.
A lot of people, though, have told me that they expect North American markets to make a 10% correction and then continue strong well into 2017. Do you see that happening?
Excuse me. Personally, I don't, Jim. I mean, that's a really common belief late in bull markets. People make linear assumptions, obviously. That's just the way we humans work. When we have something happening, we think it's going to continue to happen forever, whether it's good or bad. And so when you get late in bull markets, and this one's 6 years old, so it's certainly very mature by any standards of market history, people just tend to extrapolate it forever. So they acknowledge that it needs a sell-off, and they acknowledge that it might be a full-blown correction at 10%, but they just assume it'll keep on running higher after that. Yet bulls always yield to bears. The markets are forever cyclical. It's just an endless sine wave of cycles. Bull, bear, bull, bear, bull, bear. This latest bull is more than tripled now in the United States S&P 500 terms. Average duration of a bull at this stage in the market cycles, or average magnitude, is about a doubling rather than tripling. Average duration is 3 years as opposed to 6 years. And so I think we're definitely going to see a big sell-off, but I have a really hard time believing that this bull is just going to keep powering higher indefinitely, even for another year or two, after going for so long and going so large.
What about the influence of all this cash coming out of China?
Cash coming out of China. Elaborate, please.
Well, it seems that the Chinese market has been raising so much money. For example, last week a company was looking for $1.5 billion. Instead, they got $274 billion in offerings, the same as the annual output of Hong Kong. So it seems that they have a lot of cash slopping around there. Is that going to come over here simply because a lot of people don't trust the Chinese market?
I don't know. The Chinese stock markets are a popular speculative mania. They've more than doubled in 6 months. Their worth is like $10 trillion, US $10 trillion in market cap terms now. Just insanely high. Talk about PE ratios, trailing PE ratios around 70 times. And when you see popular speculative manias fail historically, most people don't get out. Stocks go down symmetrically the way they came up. So if they went up parabolic, they tend to go down parabolic. And so if people get scared of the Chinese stock markets, they'll start selling there. And some people get out, but so much capital will be destroyed by the shares falling before they can sell that I don't believe there's going to be a big influx of Chinese capital to the rest of the world, at least from the Chinese stock markets. The Chinese government spending, a different deal, but from the Chinese stock markets, no, I don't think it'll slash into other global markets. It'll just be destroyed when this thing collapses parabolically like it rose parabolically.
Interest rates might be on the way up. Do you think that's going to happen after the Fed meets on the 17th?
Oh, man, it's such a big Fed meeting. I don't think so. This Fed seems terrified of stock market reaction to its decisions. That was the case under Bernanke. It's certainly the case under Yellen. And the market expectations are firmly that the September FOMC meeting will be the first possible one to see a rate hike. And there's almost no one on the street that believes June is even possible. There's some reasons that June might be a good idea. For instance, as you may remember, the first quarter GDP reading in the United States was negative. And some people think the second quarter reading will be weaker than expected too. If the Fed hiked rates at this June meeting, that would kind of give it a window between first and second quarter GDP if economic data in the U.S. starts deteriorating again. But I think it'd be such a shock to the markets, Jim, that'd just be too big of a risk for the Fed. I'd give it like a 10% chance, and that's probably generous. But boy, if they do hike rates, the market's going to go crazy. It'll be such an incredible reaction. They'll probably just add a word to their statement to the effect of some kind of gradualism approach that when they do start hiking rates, they'll be slow, gradual. But I find that pretty interesting too. I've been studying past rate hike cycles just to get an idea of what this one how it might turn out. And the last time the Fed hiked rates was between June 2004 and June 2006. They took their federal funds rate, their benchmark rate, from 1.0% to 5.25% over those 2 years, and they had 17 quarter-point rate hikes for 17 FOMC meetings in a row. Now, the FOMC meets 8 times a year, and so 17 meetings they did a quarter point. And rate hike cycles before that were that way as well, Jim. And I'm starting to wonder if it's too risky for the Fed to do this one-and-done approach like Wall Street wants in the States. A lot of traders want the Fed to do 1 quarter-point hike off zero, which is nothing, then stop for 6 months or even a year and see how the markets react. But I think if the Fed does that one-and-done thing and stops, the erraticness of it, the unpredictability of it, it's going to hurt markets as well. So the Fed might have to commit to this rate hike cycle and do it, just kind of keep going, not like stop and start. It'll probably only be quarter-point hikes, because that's what the Fed usually does. Hasn't done a half-point hike since May 2000, but it's probably just going to go quarter point definitely, because the markets can't handle the uncertainty that stopping and starting does. But consensus now is for September, and I kind of agree with that just because the Fed's so worried about the stock markets these days.
What about the housing market where, I've seen a lot of real estate sales pushed where they say you better buy now because interest rates will never be this low again?
That's really interesting. Interest rates have gone down since the early 1980s, and they have to be cyclical as well, like all their markets. Central banks have manipulated them by buying bonds and forcing interest rates lower, but presumably that's got to end or at least taper off or wane at some point, and interest rates will have to rise again. And, at 30, 35-year lows, I would think interest rates, are probably going to go higher. That's just odds are that they're not going to go lower forever. Central banks aren't going to inflate, buy bonds at the same rates they're buying them today. So I would agree that rates are going to go higher, and that's going to hurt the housing market. I don't know about Canada, but here in the States, the housing market's mostly debt financed, especially people buying houses. And so if the interest rates go up, it's going to be a lot harder for them to carry the debt and finance the debt. I did a study last week, a couple weeks ago. I was looking at the average levels of interest rates over the quarter century before the 2008 stock panic. That was kind of normal time. 2008 was strange. That's when the Fed started going crazy with quantitative easing and the zero interest rate policy. But in the 25 years before that, the average yield in the 10-year U.S. Treasury was, I think, like 6.9%, Jim. And if you add like 1.9%, 2% on top of that for the 30-year mortgage rate in the States, that means the average mortgage rate was like 8.5% over that quarter century. And right now it's 4, just over 4. It ticked over 4 last week, and it was big news in the U.S. financial press. So if 10-year Treasury yields fully normalize, just mean revert back to their 25-year average pre-2008, housing prices are just going to, I don't want to say collapse, but they're going to go down dramatically in the States because people won't be able to afford to carry as much debt as they need to pay those higher interest rates.
We'll have more with Adam Hamilton right after this.
More and more people are looking to the Internet for intelligent, riveting, and thought-provoking interviews. To advertise on The Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Adam Hamilton, CEO of ZealLLC.com. Adam, what's happening with precious metals?
Well, Jim, as you know, right now we're in the middle of summer, and summer is a really interesting time for gold and silver. Summer is a time when everybody focuses on sunshine and vacation and leisure time and family, and they kind of just abandon trading for the most part. All the major gold-consuming regions are in the northern hemisphere. Of course, Asia, both India and China, are north of the equator, Europe, the U.S., Canada. And so in the first week in June, there's a strong seasonal tendency for gold to sell off pretty sharply, and that happened again this year. But the great thing is that mid-June is also a major seasonal low for gold, the major seasonal low of the calendar year. If you take gold's price behavior and index it individually each year and divide all those indexes together, you can get seasonality out of gold. In mid-June is the lowest ebb of the year for gold investment demand out of the entire year. But starting in late July and August into September, demand picks up dramatically. First, there's Asian harvest season. Indian farmers, they get their harvest in, they know how much surplus income they made during a year, and they invest some of their capital in gold. The banking system in rural India leaves a lot to be desired, and gold's been a great investment for most of world history. Then after that, there's Indian wedding season into September. Indian families believe that the most auspicious time to get married is that festival season, like around Diwali and other festivals. And so gold demand in India just explodes. We're talking about 40% of India's total annual gold demand during that couple-month period in autumn. And so right now, mid-June is the best time of the year to buy gold seasonally. I totally understand that gold seasonals haven't worked well in the last few years because of the extreme distortions in the markets courtesy of the Federal Reserve. But the factors that drive this seasonality, like deeply held cultural beliefs, income cycle things, have been around for decades if not centuries. They'll probably be around for decades if not centuries to come. So I think seasonality is going to reassert itself in a big way, and this year is as good a year as any. So I'm really excited about gold going forward over the next few months.
Any projections for the price of gold over, say, 6 months?
Well, talking in seasonal terms again, it should be at least 10% higher by say January if the seasonality holds, like the average of the past 15 years of seasonality. But it's so low, Jim. Like I believe the average in 2012, before the Fed went crazy with its third quantitative easing campaign, was around 1575, and it got as high as 1900 back in August 2011. And so, we really should be back up to 1600, 1700, 1800 here. Central banks have been printing money like crazy these past few years. So we have the biggest monetary inflation in the history of the world. Yet gold's at these incredibly low prices relative to recent history. So, it should go lots higher once investment demand returns. And that's kind of contingent on the U.S. stock markets rolling over decisively. People don't like alternative investments unless conventional stocks and bonds aren't doing well. And so since they've been doing so incredibly well the past few years during the Fed's levitation of the S&P 500, we really need that to see some serious material decisive sell-off in that before people say, hey, wait a second, maybe I really should diversify my portfolio. Maybe that really does make sense not to keep all my eggs in the stocks basket. So gold's destined to go a lot higher from here.
Adam, anything else you wanted to throw in today?
It's just so important to keep a contrarian focus. The stock market's been doing nothing but rally for several years here. Gold's done nothing but grind sideways after plummeting in 2013, once in a 93-year event, the second quarter of 2013. I just encourage people to keep a contrarian focus. Life and markets are cyclical. Nothing goes well forever. If you're doing great, watch out. If you're doing terrible, things are going to get better. The same thing with the markets. They don't rally forever. They don't sell off forever. Greed and fear just are this eternal war, battling back and forth. Markets are a giant sine wave. So if things are low, expect them to get higher. Things that are high, expect them to get lower. And just keep that contrarian focus, and it should serve you really well. Thanks a lot for chatting with us. Thanks so much, Jim. Great chatting with you. My guest has been Adam Hamilton, CEO of ZealLLC.com. You're listening to HoweStreet.com radio. Find us on Twitter or Talk Digital Net. Our popular YouTube channel is Talk Digital Network. Comments about the show can be sent to info@HoweStreet.com. I'm Jim Goddard. Comments made on HoweStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HoweStreet.com radio is a production of HoweStreet Media Incorporated.